Taxes are currently based on income, not on net worth. So maybe their net worth is $1 billion, $2 billion, $3 billion, but it doesn't mean that they're paying taxes because we are always finding ways to reduce or eliminate their tax liabilities.
What is a cost segregation? Why are mobile home parks so tax efficient? Break all that down for the listener.
The question we get is people are trying to understand, okay, if I put $100,000 in a deal, do I get $120,000 on a K1 of loss? Like, how does that happen?
And that's why I love real estate, and that's why I feel like that's the way to build real wealth through real estate, because this is the only asset class that I can actually write off the cost.
If I was to start from scratch and plan my life solely based on the tax code, I would pursue a career in real estate, be a real estate professional, and use the real estate professional designation to create a life where I pay no taxes. Welcome to another Cashflow Quest. We're really excited to have a friend and amazing guest for you. We're trying to drive a bunch of value. End of the year, tax planning, all that fun stuff. So we'd like to welcome our CPA, does all of our real estate tax prep and tax prep for our personal side, Andy Farkas with Farkas Advisors. Great to have you.
Yeah, thank you. I'm happy to be here. Yeah.
We like to call you the wizard of tax. You're our wizard.
I like that.
Yeah.
I like that. I take pride what I do, and it took a lot of time to get to where I am. But, I like working with clients like you guys and your team. That's what makes it easier, and that's what makes it fun.
Yeah. Thanks.
Appreciate that. Well, likewise.
Yeah. And give us a little bit, how did you become a CPA? How'd you get started? Was there a road to starting Farkas Tax Advisors? Oh yeah,
for sure. And I think I was born to do this. My mom is also an accountant. She's a CPA. She's not in the US. I'm originally from Hungary. But I grew up watching her bringing work home, doing financial statements and doing tax returns. So I think it probably stuck with me as I was growing up, and I liked working with numbers. So when I went to college, I on purpose, I want to get my degree in accounting. And I ended up getting, my accounting degree, getting my master's. And I joined a local boutique firm here in actually San Diego. And then in 2014, I decided just to open my own company. I think I felt I had enough experience. And I started my own company with only 3 people and only a handful of clients. And now we're sitting here in 2025, and I have 32 employees working with me, and I have 1,800 returns that we actually do. So it was an exponential growth thanks to the people that I work with. I mean, I have a great team. I have a good management team under me, and the staff people, I don't really have turnover. So I think that also helps retain clients. And then I don't do any marketing. I don't do any advertising. All the clients that I have came from client referrals.
Oh, wow.
So it's been a good journey. And I feel like I'm still at the beginning. I'm still young.
Oh yeah.
And I still have a lot of room to grow. So, I always appreciate when I have clients like you too, that you started, 10, 15 years ago, and now look where you are. But as you guys grow, my firm grows with you.
Yeah.
So that's been my philosophy, is that to acquire and work with great clients that are growing, that allows me also to grow.
That's cool.
Yeah, I love that. Yeah. Good for you. Congrats on that growth
congrats
too.
on your success.
Yeah.
It's fun.
But yes, and thank you. But I could not have done it without my clients, right? Because I provide great service, but they have to be great as well at what they are doing.
Well, and likewise, because without your knowledge and expertise, we would have a challenge getting to where we are too. So it really is a great team and partnership for sure.
Exactly.
Well, I think you're at the beginning. I mean, we try, and we get the question all the time, like, hey, do you guys know any good CPAs? And I mean, we're like, do we send more people to Andy? That's always the question. Like, we got like a fire hose nozzle. With people that are really, I feel like there's a big transitioning happen on the CPA business side where it's hard to find good ones. So I think you're just in the starting blocks too. You could probably scale as big as you want.
I could I could. And I feel like that exactly over the last couple of years, there was like a I don't know if I call it a migration, but a lot of CPAs, the good ones, have been retiring. And there is a lack of exactly the new CPAs that coming up with that strategic planning, technical background.
Yeah.
And I think my timing was good too, I feel like. And there is a lot of opportunity, but exactly that reason, I'm very selective on what clients I take on. So I could have been growing my business even more, but I am selective. So I don't work with every client that comes my way.
What's your rule of thumb, just for fun? Like, do you have a particular type of business? Like, is it like our business where it's real estate tax return entities, or that'd just be interesting.
Exactly. So that was from the very beginning. I made the decision that I have to specialize in an area where I can get really, really deep knowledge and I can provide, the value. So I only work with real estate clients. One shape or form, the prospective client or client needs to be involved in real estate, whether it's real estate development, management, investment, any real estate related work where I can provide value. That's what I'm looking for. Yeah.
Love it. All right. Why don't we go to the billionaire question?
Yeah.
Let me hear it.
So Andy, you have a pretty impressive clientele. And so we're very privileged to have you as us being a client, but given you do have some billionaire clients, and we won't name drop here, but give us the high level overview. What's the difference between how the billionaires think about tax planning versus the Joe Schmo, for lack of a better word, millionaire?
Yeah, it's in a sense, it's an easy question because, right, the billionaires think about tax planning in a strategic way where tax is an overhead. It's like an expense that I don't want to pay. So I do have to find a way to minimize the tax liability in a legal way, right?
Sure.
So that's what our tax advisors come in, and we find ways to minimize and potentially eliminate the taxes. Taxes are currently based on income, not on net worth. So maybe their net worth is $1 billion, $2 billion, $3 billion, but it doesn't mean that they're paying taxes, because we are always finding ways to reduce or eliminate their tax liabilities.
Can we break down income a little bit just before because we're probably going to go pretty deep in this conversation.
Sure.
Let's just break down the different forms of income, and then that'll give us a good kickoff to then how do you minimize certain forms of income, and what do folks that maybe are billionaires or very high net worth individuals, where do they try to have income sources coming from that is more tax advantageous?
Yeah. So as I mentioned, pretty much all of my clients in real estate. So if you look at the income sources, I think 90% of their income will come from real estate, predictable monthly cash flow from rental properties, right?
That's
what it comes
passive income.
So if I classify the income first, I would look at what type of income it is. Is it ordinary income or capital gain income? The determination of the passive or non-passive nature of it, it's a second level determination.
Okay.
So the income that you receive from a rental real estate is ordinary income, but interest and dividends, also ordinary income.
Okay. Yep.
But the determination whether the ordinary income itself is passive, is non-passive, is determined a level higher, in a sense that ordinary income could be passive and non-passive, depending on how active you are in the business. So the ordinary income generated by the real estate, if I am just a passive investor and I don't actually manage and not spending the time in the real estate, most likely it will be passive income to me.
Okay.
But if I am an actively involved individual in the business, I'm either managing it or I find a way to become actively involved in the business, now it turns into non-passive income.
Ordinary or non-passive, is that the same? Like one in the same, ordinary, or it's a form of ordinary, non-passive?
Correct. So capital gain can also be passive and non-passive.
Okay.
When it comes to real estate investments. So that's why I'm making a slight distinction between category of income and type of income. So the type of income could be capital gain again or ordinary income. But each of the capital and ordinary still could be broken into passive, non-passive. Mm-hmm. And sort of they go hand in hand. If my ordinary income is passive, then most likely when I sell that asset that generates capital gain income will also be passive. Mm-hmm. And say the opposite also true. If I have non-passive ordinary income and that same activity now I sell and triggers capital gain income, that will also be non-passive.
This is why it's fun. The devil's in the detail.
And this is just scratching the surface. We haven't even talked about portfolio income and investment income. So this is on a very high level. It's good to understand because there are also different tax rates apply
to each time.
Okay. The ordinary income has, capital gain has different tax rates. But even within passive and non-passive, there could be difference in tax rates. Okay. For example, the 3.8% net investment income tax.
Yep.
Explain that for me too, because where does that come in? Because I always calculate that when I'm trying to estimate for like a client, and I'm not a CPA, but I do try to advise and give them some sort of guidance so then they can take that information to their CPA, right? And say, hey, prove this right or wrong, but making sure you're asking the right questions. But what is that?
Yeah. So it's originated from Obama and Obamacare related tax provisions when they said that we will add an additional tax to investment income if you make over a certain amount. So not everybody it wouldn't apply to everybody, but if you make over a certain amount, I think it's $250,000 now in investment income in 2025, then we add an additional 3.8% tax on top of the income taxes. So let's say your income tax rate is 37%. Yep. Now on the investment income, which is defined as interest, dividends, portfolio capital gains like stock sales, and also rental real estate income if it's passive. So this applies to a group of income and you pay 3.8% on top of the income tax. Now, if you're able to make an argument that's not a passive income, but it's a non-passive income, at least on the real estate side, you're able to avoid the 3.8% net investment income tax because that's specifically excluded because now it's not an investment. Now it's active. It's a non-passive, which means active income. So you're able to avoid that. And exactly, I had this situation with one of my clients, maybe like 3 or 4 years ago. I took over the work from another CPA and they made like $10 million annually in rental income. And it was income. So the prior CPA did not really care whether they are real estate professional, and we can come back to real estate professional later, but whether real estate professional or not. Because like, hey, I don't have losses. Why do I care?
Correct.
But he forgot about the 3.8% tax. So just making the election when they are really real estate professionals on a $10 million annually.
That's a big number.
Big dollar amount.
So there's so much to
just like little nuances.
There's so much to talk about there because it's going to open up and I think we'll probably go into the real estate professional designation, but just stories and situations that we run into both personally and then also professionally. But I had a question written down for you. It's like, when is it time to fire your CPA? Like, people wouldn't even know that, right? You're just, on $10 million, 3.8%, that's real money.
Yeah.
Exactly.
That is real money that you're paying an additional tax. And if you just check the box because you work with a professional, they would have saved you $380,000, right? It's like, wow.
Annually.
Exactly.
Yeah.
Exactly.
Wow. How many years was he paying that?
It's kind of odd, but I feel like the big difference between billionaires and millionaires is the focus on learning the tax game.
Yes.
Because it was not easy to get to you. For us, it's like, how many people do we have to ask before a good one pops up? No offense to all the CPAs out there. But I had to ask about 10 stupid questions to learn one good nugget. I feel like if I didn't ask a bunch of questions in the beginning and I just was taking advice, I would have never figured it out. The real estate professional, and we just happen to be in the greatest business for taxation and then being a real estate professional. So it made it easier, but it's like, man, I tell people all the time about, come on, you got to figure out the real estate professional designation and you should be an S-Corp. And so all those things, that's what we'd like to dive into to make sure we provide value. Cause it's It's a deep thing, but like most people don't focus on it, and it's one of their biggest costs. One of their biggest expenses.
And the CPA, their CPAs aren't necessarily advising them. They're just filing the taxes. And so here, I'll start off with a story, and then I want to lead into the real estate professional designation. So both of my in-laws are retired. They own rental income. So they're a firefighter teacher. They're retired, and their business now is their rentals. That's their main form of income, rental homes. Yeah. And my mother-in-law, they sold some property, had some ordinary capital gains from the asset sale, right? And they reinvested those proceeds back with us. And I was like, hey, just are they? And I know that no matter what, you could defer that, right? Because it's same. Rather, you don't have to be a real estate professional. But I was like, does your CPA have you checked as a real estate professional? Because they go pick up the rent checks. They're dealing with the tenants. They're dealing with the handyman all the time. And she's like, I have no idea. And so I said, when you go to do your taxes, I want you to put me on the phone, put me on speaker, and I'll talk to your CPA. And I just asked them a couple of questions like, hey, do you have them as a real estate professional? No. I was like, well, they're both retired and their main form of income and their main business is the rental property. Would you agree they're a real estate professional? Yes. I said, will you please check the box? I said, okay. Hung up the phone. Yeah. And so, but that's one story in a silo, but I hear that story, 100 times in a quarter from clients.
Where was the CPA on advising, hey, this might help you save a few bucks? Like that's the part that's kind of sad. Yes. Like,
why don't they?
I know.
I think it's because what my experience is that most CPAs are more generalist. They don't really focus. Mm-hmm. That was my business plan from the beginning, that I want to focus in an area and learn that area really well. But if you talk to most CPAs, they don't just do one thing. Mm-hmm. And I don't know, the tax code is like 70,000 pages or something. So it's impossible that you're going to know everything.
Yeah.
And if you have 500 clients, let's say, and each client is different, you're not going to be able to advise them.
No.
And not going to be able to advise every single client.
Correct. And they'll have maybe a couple of good ideas per their client base, but like, how do you know them all?
Exactly. Yeah. Exactly. And for exactly that reason, I only have 40 clients. But among the 40 clients, I have enough work, 1,800 returns, right? But that allows me to exactly focus in the areas that's important for them. Because it's only 40 clients that I have to advise. Yeah. I am able to meet with them anytime. They have time, I have time. I don't have to split my time, and I'm focusing specifically on that area. And I think that's what allows me to be able to advise them well and pay attention to the little details. Because even this example, it goes just what I gave you. Yeah, they didn't have losses, so it didn't really matter whether they're a real estate professional. But by making the election, they're saving 3.8%.
Huge.
That's it.
Yeah.
But it doesn't matter if even a small client like this.
Yeah.
It could be a big deal.
It adds up. Yeah. It adds up over time.
100%. Yeah. Well, let's go. So we talked about, the different forms of income, passive, non-passive. There's another layer, which, I'm just going to kind of jump to it, which is, the active versus passive. But how you can defer income depends on this real estate professional designation. Can you, in simple terms, explain that? And then we'll continue to go a little bit deeper into it.
Sure. So I think it's very important to understand when you have losses and income from various sources, how they really net down on your personal return. Most real estate investments are made through partnerships, which are pass-through entities, so they issue K-1s. And some investments will generate income, some investments will generate losses. If you are a passive investor in these deals, meaning that you're not actively participating and you're not a real estate professional, there's a rule that if your losses exceed your income, those losses cannot be used against any other type of income. Passive losses can only be used against passive income. So yes, the losses help reduce or eliminate your passive income, which means that you can net income with net losses from rental real estate business. But that's it. You cannot use it in any single year. Doesn't mean that you lose it, but you have to carry it forward. And carry forward those passive losses can only, again, be used against passive income.
So that would then apply to somebody who earns a W-2 income, works, doesn't necessarily that's ordinary income, not passive income. So those passive losses are going to kind of carry forward on their book. So we've got clients that are like, well, how do I get strategic?
You're 100% correct, because I'm assuming that when I invest in real estate, I'm using some other source of the income to make those investments.
Right.
It's probably going to be W-2. I have maybe some interest, some dividends in brokerage accounts. Maybe I have Social Security. Maybe I have retirement income, required minimum distributions.
Right, which is
gains from capital gains. Now, all those income are ordinary income, but they not considered business income. They consider non-business income, other than the W-2. But all the other type of income are considered ordinary income, but they don't match with the losses that generated from passive activities. So you could have $500,000 in passive losses and $500,000 in W-2. You still have to pay tax on the $500,000 W-2. They don't offset each other. That excess $500,000 of passive loss would carry forward to future year. So that's where planning and trying to get to that real estate professional status, it's really beneficial. Because now, if I have excess losses from rental real estate activities, I can convert them to active losses. And active business losses with limitations can be deducted against other type of income that are non-business income, like W-2 interest, dividends, capital gains. So that's where that really becomes important, is that if I have losses from real estate, or if I want to reduce my taxable income from other sources, how can I get losses from real estate to be able to offset them?
So if you're not a real estate professional, and you have passive losses through a K1, through a passive partnership, say you invested with Comfort Capital, how can you use this excess depreciation?
So this excess depreciation is still considered business income and business loss, right? It turns into a business loss and it's passive. So as long as you have an activity that is a business income that you are passive, it doesn't have to be real estate. I could be an investor in a plumbing company. Right. But I'm just an investor. So it has ordinary income from the plumbing business.
A lot of guys do single family home first trust deed notes with a company. So that would probably flow through as passive.
I wonder if that would be considered interest income, not necessarily, active business income. Okay. So it depends.
Does that apply or not apply?
Interest income falls into a different bucket. It's called portfolio income.
Oh, okay.
So passive losses that you generate from passive activities could not be used against portfolio income.
And portfolio income is also stock sales.
Exactly.
Okay.
Interest, dividends, stock sales, they're not considered business income. So meaning that if I have passive losses, I can only use it against passive business income.
Yep.
I cannot use it against anything else.
Which is hard to control exactly how that all inputs into their scenario on their tax return. Yeah. Depending on how the CPAs are doing it on those businesses' side.
Exactly.
Man.
So that's
it's
hard.
Pretty complicated for us to guide people then, because it's like, that's what we tell them is like, we don't have full optics on your situation.
Yeah.
And they don't either.
Yeah.
Well, going back to your comment, if they don't have these discussions with their CPAs, they would not know.
Most clients too have 401ks or IRAs or bonds or hard money loan interest or something like that. And it sounds like all of those are treated differently and wouldn't be then offset by these passive losses from.
That's correct.
So, when not, especially not having full optics,
you've teed it up too nice. So then if you do become a real estate professional, what of those does it cover?
In any given year, then I am allowed to offset, at least right now in 2025, up to $626,000 of that income.
All of it.
All of it. That's the limitation, the $626,000. So if I have $500,000 in interest and dividends, and I'm a real estate professional and I'm able to generate $500,000 of losses, now I can net the two down and my tax liability becomes zero in that
now,
situation.
If it's over that $626,000 and you have more income than that, and then your losses are going to go to $626,000 for that year. But if you have more than that, and that you could necessarily say you had $1 million worth of losses, but this is only going to allow you to use $626,000. You don't lose the remainder of that. You get to carry it forward, which is another piece that I would like you to kind of go in and explain. Maybe am I going too fast?
No, before you do that, because that's like 3.0 and we're definitely going to cover it. But before you do that, I just want to put a finer point on. So of the $626,000, this could be 401k to Roth IRA conversion income, right? So you could do backdoor, IRA conversions.
That's right.
This is dividend income. This could be capital gain income if for selling stock portfolios. This could be from selling a business, whether it's a asset sale or a stock sale.
Yes.
Which we'll probably get into too, like selling, entrepreneurs selling businesses, how to mitigate taxes. So it really opens up the doors. I mean, if you are a real estate professional, it really is, in my opinion, the most tax advantageous strategy you possibly can do.
Exactly, 100%. Yes. That's where that planning comes into play. Then, okay, how can I get to?
Yes.
Can we ask you that? Yeah, that's what I was just going to ask.
Okay?
Yeah, my advice to everyone is you should figure out how to re-engineer your life to be a real estate professional.
Exactly.
And be legit. And do it.
Yes.
Yeah, exactly.
So, what is the requirement?
There are multiple ways to do it. And again, I don't know the audience, so I'm not providing tax advice to them. So I always recommend, hey, talk to your CPA about it, how you can do this personally. Yeah. But to give an example, a couple and the husband is working in some tech industry and they generating interest, dividends, and capital gains, and a wife is just staying home and is a stay-home mom and trying to find a way to, as a couple, to be a real estate professional would be an easy way if we make the wife a real estate professional, because what the rules state is that I have to spend at least 750 hours in the rental real estate business. And that has to account for at least for 50% of my working time. It's hard to accomplish if you're working in tech and you're working 2,000 hours.
Yes.
So you couldn't do it on that side. But in this scenario, if I can make an investment in real estate just on a personal side and have my wife manage that real estate and get to that level of activity where she spends the 750 hours, it's going to be more than 50% of her working hours because that's all she does,
Right.
technically. Now I can make an election to treat her the real estate professional. And because we're filing a joint return, that election applies to our combined income. So if she is a real estate professional, by definition, the husband would be also qualified under this election. And when they're filing the joint return, the losses generated through her real estate professional status could offset the income that the husband generate through the tech
There's
company.
the magic, everybody.
Yes.
That's one of the ways, and that's probably the simplest way. Again, I would just recommend talk to your CPA how to, make this bulletproof, but that's definitely a way to do it.
So what if you have a retired couple who both don't work anymore and they're trying to figure out, they have Social Security and real estate income and things that they're trying to offset, and they're a passive investor. They really don't have any, they want to be passive as much as they can. How would you recommend somebody like that being legit in selecting that box of real estate professional?
In that case, I would question, what are those real estate investments that they are invested currently in?
Okay.
If they just invested in a limited partnership or an LLC where they just like purely passive, you can't really do much with that because then become passive. So what I would tell them is that maybe try to, when you have to refinance, something happens or there is a sale of these LLCs, maybe instead of reinvesting them directly into an other passive deal, maybe buy a condo that you can just rent out yourself, just to be able to make an argument that one of you spending the required time and meeting the real estate professional election status.
Do they have to spend 750 hours total or 50%, or is it like both?
One of them.
So
Both of them.
let's use somebody that's retired that has a condo. It doesn't take 750 hours to manage a rental condo, let's say, but that's all they do.
Yes.
So does that qualify, even though they're not spending something?
They should find a way. That's how I will put it.
Yeah.
That they should find a way to document they spending 750 hours in the activity, whether it's related to maintenance, whether it's related to talking to the tenants, fielding phone calls, maybe looking for other investments at the same time, exploring sale opportunities, or maybe I'm going to sell, maybe I'm not, I'm going to do a 1031 exchange, whatever that the case be. I think they have to find a way. Because that 750 hours is the minimum that you need to spend in order to be able to argue that you're a real estate professional.
And I think the important piece is to make it bulletproof is the documentation, is being proactive and not reactive on documentation. So like, the start of the year, you probably should plan out on a Google Calendar, like where you're going to spend your time. And obviously things come up and it's like, oh, the faucet broke. I got to go down there, call the handyman and go check on it. But you want to kind of have a cadence of how you think about managing it. That way you're not, backtracking to then say, okay, where were we on the 13th of July? And, okay,
can you get audited?
Exactly. Right.
Yes, 100%. And then just going back to your comment on how I get, that 750 hours doesn't have to be spent only on that condo, right? Because now if I have that condo, that's my starting point.
Yep.
But now I can aggregate all my real estate activities. If I have other investments and I'm spending time on those investments as well.
Yeah, then it can be an aggregate.
Correct.
Yeah.
Now I can make, because this election, this real estate professional election, what it allows for is aggregating all your real estate activities into one activity. So now it's just going to count as one activity. That's why you're allowed to deduct the losses, because now it's considered one activity. So you have to keep track of your time, but having that condo on the side gives you the ability to argue that, yes, that's where you're spending most of your time. But really you're spending, once you combine and making that election, you have, in aggregate, you have the 750 hours across all your real estate portfolio.
So that means that for anyone listening, that all your conversations with me, Blake and Jen,
they
call me.
They count towards that 750 hours.
Exactly.
Yeah.
Put it on your calendar.
It is. And that's exactly that. Going to your point, that's the very important point, that you have to document it.
Yes.
Taxpayers get into trouble when they get audited 3 years down the road, because that's the statute of limitation, and they're trying to recreate their calendar or the documentation and prove it that, 2 years, 3 years ago, I did spend the time. That's what the IRS doesn't like.
Yeah.
That's what's going to be thrown out, and then you could be, in trouble. But if you document it as you go, and it's readily available when the IRS knocks on the door and asks for it, then you should have no issues.
What's like the dream of a backup in your case? If we got audited, what would we need to provide you? Is it a list, like a log on an Excel? Like what should they keep versus, I feel like a calendar doesn't really do you that much good. That'd be how you plan.
Yeah.
But then how do you track the time?
Yeah.
It's actually, a calendar would be a good way if you're able to complete the calendar, and then you say that from 10 to 12 that's what I did on that day.
Okay.
And then most people nowadays already using some sort of calendar, Google Calendar, Outlook, whatever. So that would be my recommendation, because that history remains essentially forever.
Yeah, you can go back and look where you were on that day.
And then you can just print it out.
I think you can,
export it. That's the IRS would ask for that. Can you print out something for me? And that would be really easy to do that. It doesn't mean that you cannot do it by hand and just write it down and then now keep it on paper and then just scan it in, or, you can do that, no problem. But I found that most of my clients put things on their calendars anyways.
Yeah.
So now just putting a little extra notes at what I did and how I did it and how much time I spent exactly.
So when you book that meeting and it realistically takes 2 or 3 hours,
exactly.
By the time you go there,
because you're
it's
driving.
if it's at 1 o'clock and you're going to get ready and go at noon and it takes you 3 o'clock till you get home, then you block that
3
time.
hours.
Yeah. And exactly. And just make sure you talk to your CPA, make sure that it's all, documented properly and the right descriptions are, in the calendar. And I think as long as you do that you should have no problem.
Yeah. And I think it's just all the intent too behind it of being serious and professional. And that always goes a long way. So we got a major tax bill that got passed on July 4th of this year, the one big beautiful bill. I think everyone at this point.
Yes, thank you.
Yes.
Yeah.
Yes.
Yeah, thanks,
Exactly.
Mr. Trump.
Yeah.
Yes. And so, I think at this point, everyone understands accelerated or 100% bonus depreciation. But I do want to dive into that. And then if there's anything else that was passed on July 4th that maybe, is people don't really recognize, whether it's like is it the SALT, increase? Just some other things that happen within that bill that probably don't get talked about as much as the 100% bonus. So let's just talk about that tax bill and what was approved. What are things that, that people might have missed that they're going to get reminded of when they file for next year?
Yeah, I mean, so that was definitely the 100% bonus depreciation. And one of the other major, I think, change that was made is related to exactly that $626,000 limitation that was supposed to expire in 2028, right? So we could have gone back to the original rules where there is no limitation in a given year. You can, if you're a real estate professional, you're able to take any losses against any type of income. Unfortunately, they made that change in the final version. They made it permanent. And now it's until, again, somebody comes and changes it, it's going to be in the tax code. And they were trying to, I don't know if you know that, but they were also trying to change I don't think we talked about that yet, the NOL rules as it relates to. But luckily, they threw it out at the end. So we don't have the issue anymore. And we can talk about that more, the carry forward NOLs. So that was another thing I was worried about, that they're going to do that. You mentioned the SALT limitation was increased from 10,000 to 40,000, but then they also made it subject to income limitations. So most of my clients were not going to get any benefit from it because if you make over a certain amount, you default back to the 10. So it's it's not really gonna matter. But the good thing was that they continued something called and it's really helping the California clients, the pass-through entity tax election, the PTE under California AB 150. So that they continue allowing that on the entity level.
Yeah, what is that?
So that circumvents this $10,000 limitation on the personal level. So this SALT limitation on the personal level is that, okay, well, you can only deduct $10,000 in state taxes, property taxes, any kind of taxes that you have related on the personal level. Now, California, being a high income state, they realized that that's not good for us Californians. So they found a way, and the IRS agreed to it, to follow that and allow that if you have taxable income from a pass-through entity, that pass-through entity itself, which is a partnership or an S-corporation, if it's a qualified partnership, a qualified pass-through entity, it can pay the state income tax on behalf of its individual owners and take a deduction on the pass-through entity level, on the partnership level, without being subject to the $10,000 limitation.
Oh,
so let's say you have if you have $1 million in income and that's your only source of income and it's coming from a partnership, then that $1 million, if it ends up on your personal return, you would pay $100,000 in California taxes, right? Just 10%.
Yeah. Mm-hmm.
So then you would be only able to deduct in the following year, because you paid the tax the next year, only 10,000 of the 100,000. But if you make an election on a partnership level, and it's a qualified partnership, and when you make it on behalf of your owners, then the partnership pays the 100,000. It's not exactly 100,000 because there's a limitation. It's 9.3% that you can pay. So it's 93,000 that you can pay. The partnership can pay. The partnership can take a $93,000 deduction on the federal return, and it just flows through the K1 just like any other rent or real estate loss, any other real estate expense. So now you're not subject to the 10% or the $10,000 limitation because it's not an itemized deduction. So that was what was another positive change that they made permanent, because it would have expired in 2026. So they didn't make it permanent. They extended it to 2030, 2031. So again, that's helping California taxpayers who have California tax liabilities, because now they're not subject to that $10,000 limitation by making the selection on the partnership level.
And prepaying the California tax.
Essentially prepaying, but it's similar to like making estimated tax payments on your personal level. So it's the same thing. So the timing is a little bit different, but you prepaying it, but at the same time, at least you're receiving a tax deduction out of it. Otherwise you would lose it.
Yep.
And you're able to make it out of the company instead of personal.
It reduces your California taxable by a little bit, by whatever that much is.
So 100%, because now that once the partnership made a $93,000 tax payment on your behalf, that passes through to the individual as a credit. So you just claim that credit on your personal level. So instead of having a $100,000 tax liability on the personal level, now you only have an $8,000 tax liability, let's say, and that you make that payment, and now the entire $8,000 would be deductible, let's say, if it fits within the $10,000 limitation. So these rules are complex too, but that was definitely one of the things that we welcomed as CPAs, that at least, we still continue doing it until 2030.
And that ends up being on more of a personal entity, basically, like a business entity, but it's not on like a LP, like a partnership level where it passes through as a K1.
It is.
It is?
It is.
So would we be doing that on the behalf of LPs, or? If
you have California income, because it's based on the California income. But if you have losses,
figure out the application.
If you have losses on the California K1 that you would do to your LPs, there's nothing to do because you're not passing income through to them. But if there is income on the California K1, then you could make the election to do that and pay it on behalf of the electing partners. It's not required. And it's also, you can pick and choose. So let's say you have 50 partners and 20 of them decides, yes, do it for me. The other 30 decides, no, I don't want you to. You could do that too. So whoever makes the election can do that and tell you that they want to make the election.
But the entity would need to be making revenue and be a California entity, California business, California revenue.
Yes.
So for outside California, it's kind of a moot point.
It's really for the California taxpayers and individuals. So it's for California residents. Even if the asset is outside of California, I would still be tax donating in California.
Yeah.
Because I'm a California resident and California residents pay tax on worldwide income. So you have an asset in Texas, generates $1 million of income, but I'm a California resident. I still pay tax on $1 million. So it would still make sense to do this and make this election and payment. If you don't have losses again from other sources, right? Because maybe this entity has income, that if you have another entity has losses, then on the personal level, it nets to zero. Then no reason to prepay anything because you're not going to be paying California tax.
So once you have a tax liability, this becomes a mechanism that you'd want to use.
Yes. And it's more this responsibility of determining whether you want to do this. It should fall on the personal CPAs, not really you guys as the sponsors, because you don't know the personal situation of your investors.
Sure.
So even if maybe you have income coming through on the California K1, it doesn't mean that as me as an investor would want you to do it, because I have to talk to my CPA. Would I benefit from it at all? Do I have California tax liability? Do I have other sources of losses? Any other situation. So I would have to come to you that, hey, Blake, can you make this election for me?
And then the entity would have to pay the tax though.
So the way most of my clients, the way they handle this is they withhold that amount from their distribution. So they, if there is a $10,000 distribution and there is $2,000 tax liability that the partnership would make, then they only distribute $8,000 and the $2,000 they just send it to the government.
Got it. It's a quick way to calculate.
It's a quick, exactly.
And coverage.
Exactly. It's a flat 9.3% tax rate that they say, okay, if this is your taxable income on the California return, 9.3% should be submitted to the franchise export.
And at that point, you would be making the election on behalf of that entity, that partnership, and helping that partnership pay it, and then it would flow through as a credit.
Yes. Yeah.
Interesting.
Yeah.
I didn't know functionally how that would work.
It can become administratively really burdensome on the partnership. So I have clients that just decided not to do it at all. Think about if you have like 300 partners in a partnership, and now you have to just pick and choose because it's not consistent, and just administratively, trackingly, what distribution, who, when, what. So again, most of my clients, they do it only on their personal entities without investors. When it comes to like the larger partnerships, it's just not feasible.
You can do that with an S-Corp or an LLC.
Exactly.
Okay. Well, that leads into the S-Corp.
Yeah. Should we go down to S-Corp?
Yeah.
There's so much to talk about. It's like,
so the question I'd say from just a offering for small business owners, I feel like I've become like a S-Corp spokesman, and I'm not that sharp on it. You know? I just know how I do it. So, and you and I've confirmed like several times, because it's like, well, I have this type of business. No, I'm pretty sure you should just do an S-Corp. You know, and all roads in everything I've ever like asked, all roads lead to, if you have a service-based business, which is most businesses, you're providing a service and you're getting paid, you would create a corporation that's an S-Corp. And so, but then a lot of people get hung up on that, like C Corp, S Corp, what the heck?
Yeah.
Why can't I just do an LLC? And then you know, if you chat GPT it, LLC can be designated an S Corp. So like, I'd love for you just to break down, if you were a service-based business and you were a sole proprietor, basically you're just doing it under your name for the time being, you start to make a decent amount of money. How do you transition?
Yeah, it comes up pretty often because, as you said, a lot of us have service-based business. Like me as a CPA, I'm providing services. I have an S corporation, and really the way this transitioning from just like a Schedule C sole proprietor business to an S corporation is fairly simple. You just need to create an entity within the state that you're located in. In California, you file some paperwork with the California Secretary of State, and you form a corporation. Initially, when you form a corporation, every corporation starts out as a C corporation. Just by default, you're a C corporation. But you can make an election to be treated as a subchapter S corporation by simply finding a couple of other forms. And the difference between a C Corp and S Corp is really tax treatment, simplistically. Right? A C corporation does not issue Schedule K-1s to the individuals. They, provide 1099 dividends if there are distributions. An S corporation is still a pass-through entity. S corporation pays tax to the federal government. C corporation pays tax for the federal government. S corporation does not. It has no federal tax liability. It has some California franchise tax if it's registered in California that it needs to pay, but that's it. And forming the S corporation itself is very simple. Anybody can do it. I would hire an attorney who does that for you. And then the CPA would make the election itself to be treated as an S corporation. You had a comment about LLC versus S corporation. And if you just form an LLC and it's a single member LLC, meaning that you are the 100% owner of the LLC, unfortunately, it doesn't really do anything for you for income tax purposes. It helps with legal liability, but a single member LLC does not exist. It's a disregarded entity for federal tax purposes. So the taxability of the income will remain exactly the same. They are subject to both income tax and self-employment.
So there's a myth there that you can have an LLC and can basically operate as an S corporation.
It's not a myth, but you have to convert that LLC into an S corporation for tax purposes.
If you're starting fresh, you might as well just start a corporation and take the S Corp designation.
Exactly. That's right.
Well, and a point that he just brought up too, which is a key piece, I think, is it's the self-employment tax, which is at 15%.
Yeah, 15.3%.
So that's a big piece for us. That's how we figured it out, where before, we were self-employed. And so the income we paid taxes on and self-employment tax. And so it was like, whoa, wait a minute. How do we get rid of that piece over there? Yes. And the S Corp is the key to that, because what he was just saying then is the LLC, it just would flow through. You'd still pay the self-employment tax. So the S Corp is the structure that then gets rid of that piece.
Yes.
That's the key distinction.
So putting a finer point on it, if you have an LLC that you elect as an S Corp, there's no payroll kind of function in that where you're paying self-employment tax on all the income?
Not all the income. So if you're an S corporation, you still required to issue like a reasonable salary, reasonable compensation. Yeah. But think about if you have $1 million coming into the business, and the reasonable compensation is, I don't know, 150,000, depending on the circumstances. Yeah. Then only that $150,000 would be subject to self-employment tax, not the remaining 900 or 850 in an S corporation settings. Then that remaining amount would be only subject to income taxes.
Yeah.
So then do you even need to run payroll and do withholding, or can you just put it down and do draws that are at that $150,000?
So the IRS recognizes this strategy that you create an S-corporation and you can avoid the self-employment taxes. So they do want you to have some payroll, and they don't have a dollar amount. It has to be reasonable.
Yeah.
Exactly. So whatever that reasonable represents in your specific business, that's what you should really, try to accomplish and try to do.
He mentioned though, the LLC, you'd have to convert it to an S-Corp.
Yes.
Got it.
So there's no designation necessarily is what I'm hearing.
So if you're just a sole prop right now, they might as well just go straight to the S-Corp.
Yeah.
But if you've been running your business as an LLC, then as opposed to having to create a brand new entity, change the name, all that stuff, that's when you would just convert it for tax purposes, just convert it to an S-corporation. Yeah. So that is perfectly fine.
And it is a conversion though. It's not a designation.
It is a conversion for tax purposes. Yeah. So which is an election. You make an election to treat the LLC as an S corporation for tax purposes. So the name of the entity, the business, is still going to stay exactly the same. ABC LLC. Yep. But for tax purposes, it's going to be treated as an S corporation. So as opposed to filing, a California form or a partnership form for the LLC, now you would be filing an actual federal form 1120S S corporation form and Schedule K1 coming out of it.
And that does work even though there's only one owner?
Correct.
Okay.
You'd probably you'd want to issue payroll then from the LLC or the S-Corp so that you have some sort of payroll on the books in that case so that you have that reasonable salary if it's just the one person too.
Exactly.
Yeah.
Yes. So that's one of the, I think maybe that's what you're also asking is an LLC 100% owned by an individual does not exist for tax purposes. But an S corporation owned by 100% by an individual does exist for tax purposes too. It files its own return and issues Schedule K1 to that one owner. So that's a slight distinction between LLC and S corporation too. That's another reason I like technically an S corporation as opposed to an LLC too, because if you're just running it as an LLC or just a sole prop, everything runs through your Schedule C. For whatever reason, the IRS likes auditing individuals with Schedule C, business income, business expenses, because they think that, that you're trying to hide something. So it's always been on the radar more than if you just pick up a Schedule K1. So in addition to having the income as the self-employment tax benefit of using an S corporation, it also reduces your audit risk because now you don't have the Schedule C anymore from the business. You just pick up a Schedule K1 and it's less likely that you're going to get audited. Now the chances of getting audited is still very low, but at least you're removing an element that's just unnecessarily there.
Yeah.
So and if you were going to set it up today, fresh, the key is probably to set up an S-Corp for the business income. And if you're in real estate, and then the LLC to hold real estate interest.
Yes.
That's kind of
liability protection.
Yeah, liability protection
Asset
and so forth.
You wouldn't want to hold assets in the S-Corp.
Correct.
Operate the service-based, fee-based income through the S-Corp and then hold assets in the LLC.
Yeah.
Yeah, that's right. And there are a bunch of other nuances to this because I would never want to put real estate into an S corporation structure too, because there are also limitations on what you can deduct, the loss limitations, because in an S corporation, you have limited basis, and the basis is only limited to your contributions or the loans that you make to the business. So if you put the real estate in there, and let's say you have depreciation losses, or you take debt finance distributions, now you're not able to benefit from those losses because you don't have enough basis in S corporation. In LLC, you have a lot more flexibility. Yeah. So I know maybe we're going into too much detail, to the listeners, but there are a bunch of other benefits to have that separation, have the service-based business in an S corp and real estate in a pass-through entity, LP, LLC, GP, whatever it is.
Let's switch gears and go back to a limitation, since you just brought that up, the 461 limitation. And then let's talk through some strategic tax planning. This is probably going to be more for the high net worth earners, right? Starting with this 461 limitation. Just to recap what you said, if you're a real estate professional, you can create excess losses, paper losses through depreciation, depending on what asset class you invest in, right? So say manufactured housing communities, they produce a lot of upfront depreciation. But you can only offset up to 600 and is it 46 or 26? One of those numbers?
Currently, it's 626.
626. So you can only offset up to $626,000. And then anything in excess, you don't lose it, but it carries forward. So why don't you just kick us off from there on how you go through strategic planning?
Yeah, and this definitely is part of a multi-year planning, right? Because I think the name of the game is not just creating losses in any given year, but to create excess losses that turn into net operating losses.
NOL.
NOLs.
That's
exactly
the acronym we've been using.
Yes, exactly. So if you're a real estate professional, that's where the real nugget is. That's where the real benefit is. Because that 461 limitation only applies on a year-by-year basis. So that $626,000 limitation, it only applies to 2025. If I create that excess loss, and now I have an NOL that I carry forward, let's say, into 2026, that 461 limitation, as it relates to that NOL, it doesn't apply in 2026. Now I am able to offset, under current rules, up to 80% of my income. There's an 80% limitation in NOL carry forwards, regular NOLs from any given year to the next. So that's huge.
That's huge.
Because now there is no cap of how much losses I can use.
Yep.
The only cap is that I can only offset 80% of my income.
Yep.
Say it in other words, in 2026, I have a large event and I have enough NOLs. I only pay tax on 20% of my income. 80% is eliminated if I have enough losses. Which, think about it, if I have a 30% tax rate, then eliminate 80% of my income, my effective tax rate is like 2%, 1%, 2%.
Yeah.
Going back to your question on what makes the billionaires, that's one of them.
Yes. Yep.
They try to grab as much losses as they can in any given year and play this game, roll forward these losses. So I can reduce my effective tax rate to pretty much nothing. Now, I have to clarify that this is a federal law, so it doesn't apply to California. And some of the states conform, but some not. So just strictly California doesn't apply to California. But on the federal side, 100%. This is the name of the game. Create NOLs that can then roll forward and essentially eliminate your taxes in the following year.
When people play this where if they're going to have an exit or, a sale of some sort, and they can push the NOLs into the next year and even delay a sale of some sort, then you can use 80% and big difference on a tax bill.
Exactly.
And you should invest now. Get in the year that you're going to have the gain. I mean, you want to put as much as you can put in so that you have the max out this year, but then the next year carry forward of the net operating losses.
Exactly.
Yeah.
That's why I love this big, beautiful bill that just got passed because of the 100% bonus depreciation coming back that allows to create these excess losses. So me personally, I'm tax planning for myself too. And I have similar situation that my clients, I'm using these depreciation losses, excess depreciation losses too, to help with my tax plan. So I would put as much money as I can into real estate. As you guys know, I love real estate. I love mobile home parks because this is the most tax advantageous way for me to generate losses. So that's what I would recommend everybody who is really considering investing in real estate is to try to over invest because those will reap huge benefits in the following year.
You're speaking my language.
I know.
But let's dive into, if you don't mind, just our space, because you do all the K1s and the cost. You have another business that does all the cost segregations. What is a cost segregation? Why are mobile home parks so tax efficient? Break all that down for the listener, and then maybe compare it to another real estate asset class of why we're able to capture so much upfront depreciation versus maybe like a retail center.
Yeah, I think one thing to piggyback and add to that is a question we get is people are trying to understand, okay, if I put 100,000 in a deal, how do I get 120,000 on a K1 of loss? Like, how does that happen? So I'll let you answer that one too.
So, when you, and that's why I love real estate. And that's why I feel like that's the way to build real wealth through real estate, because this is the only asset class that I can actually write off the cost through depreciation of that investment. There's no other asset. Yeah, I can, certain assets I can take tax credits and so, but this is consistently allowed under the tax law, no question.
Yeah.
So that's what depreciation is. If I buy a piece of real estate, and it's not even the money that I'm investing, but the purchase price itself that is eligible for depreciation. So now the question is, how much depreciation can I take? That's where the cost segregation study comes into play. Because under general rules, if you don't do a cost segregation study and you have, let's say, you said a retail space, it's depreciated over 39 years. So you have to do an allocation between, so you have a purchase price, it's a $10 million purchase price. You allocate that purchase price between land and improvements. California, let's say 30% in California. You allocate 30% to land. Now you have 7 million remaining in the improvements. If you don't do a cost segregation study, you have to depreciate the entire 7 million over 39 years.
Just straight line?
Straight line, 39 years.
Yeah.
So that's, you're not really getting anything out of that.
A little bit, but not much.
Very small. Yeah. That's nothing. Yeah. So that's where cost segregation comes into play, because if you think about it, when you bought that retail space, you didn't only buy the building. You bought certain components that depreciate faster than the building itself.
Pipes, roads,
the build outs within the spaces, the carpeting, the
wall,
anything, electrical, anything. So a bunch of assets that are available to be broken out. So this cost segregation study is an engineering-based study, and we go in and physically inspect the entire property. We spend couple of days, depending on the size, but we typically spend a couple of days on these studies, just on the site visit itself. We measure everything. We review drawings, anything that we can get our hands on, because the more we can find, the more we can accelerate, and the more we can allocate to shorter lived assets. So if I'm able to capture 5-year assets, 7-year assets, 10-year, 15-year assets, it's not only that I just reduced the amount of the years that I can depreciate these over, but these are special assets. These are eligible for something called, that we discussed, the 100% bonus depreciation. Anything that's under 20 years, in general, will be available for first year write-off. So if I am just on that 7 million, I'm able to allocate 2 million to these asset classes through a cost segregation study. As opposed to taking a $100,000 deduction in first year, I have $2 million of deductions in the first year. That's what the benefit, a real benefit of the cost segregation study is to be able to find these components in the building that are eligible for the 100% bonus depreciation. And different asset classes depreciate differently. Retail is probably one of the lowest amount of these qualified assets, 5-year, 15-year assets that you can get your hands on.
You have a lot of buildings and a lot of
buildings, a lot of improvements, permanently constructed.
It's a lot of things that have a long useful life.
Exactly. That's exactly right. And even if you go a step further, you go to multifamily investments. They still apartments, they still a lot of components, common areas that you, elevators, whatever. Yeah. You cannot get a significant amount of these qualified assets.
Yep.
So then what are the asset classes that would be eligible for the most amount of depreciation you can grab? Well, you would look to the ones that they don't really have physical, vertical improvements.
Yeah.
That's when mobile home parks come into play.
Yeah.
Exactly. Because you don't really find, other than maybe like the clubhouse, you don't really find any physical improvements, vertical large improvements that would take away a big chunk of the purchase price and allocate it to this, 39, or in a residential setting is 27 and a half years. But you really, in a mobile home park setting, you end up with a bunch of land improvements. The roads, the pool, the
sewer lines,
gas lines, infrastructure, everything. Those all under the IRS guidelines fall under land improvements, and land improvements depreciated over 15 years. So now you end up with a same $10 million purchase. You still have to allocate between land and improvements. And let's just go with the same example. If I have a 30% allocation, so I have apple-to-apple comparison, I have a 30% allocation to land and 70%, so $7 million to improvements. And the entire $7 million is eligible for 15-year depreciation life. And that's eligible for 100% bonus depreciation. Now I have $7 million in tax deduction in year one.
Woohoo!
That's huge. That's just amazing to get it from one asset. Now, if you go to out of state and let's say you invest in Arizona or Texas, you can even go even bigger.
We do that.
Because because now you're not really in California. So maybe the land value is not even close to 30%. Maybe it's 10, 15%.
Yeah.
So now your purchase price can be allocated, 85% of it can be allocated to improvements that are eligible for the bonus depreciation. But now it's like $8.5 million in my example would be depreciable, eligible, 100% bonus depreciation. So you take $8 million in deduction in year one. You can't get anywhere else. There's no such thing that I buy something for $10 million, I get an immediate write-off for, for $8 million. And there's no such thing.
And the best part too, and there's one more part to that to get to the 120. It's the mortgage or the debt. That's right. So do you want to just wrap that up as well? How do we get to 120 in
Exactly. And it could be more.
Yeah.
Honestly, it could be more because it's
I'd say right now, and definitely leaning into more of a stabilized asset where you can put less down.
Yeah.
Just generates more losses.
Exactly.
So we're hunting for those.
That's right. But that's why I mentioned that it's based on a purchase price. It's not on the equity that you're putting down. Yes. So the higher the loan that you can get on the purchase can drive up that percentage that you can deduct. Because even in a 50-50 scenario, a 50 LTV, you put in $5 million or $10 million asset and you get $8 million in depreciation. I mean, that's already 1.5. Yeah. 1.5, 1.6. So in that example alone tells you the power of using leverage and then creating the tax deduction and getting your money back.
Yes. And the great thing too is that these deals, they cash flow, they appreciate. So you and then you always talk about like the time value of money. Saving $1 today is so much more valuable than saving $1 tomorrow, right? Because of inflation and opportunity costs. Yeah. And so using today's dollars to offset today's active income or, W-2 income, if you're a real estate professional, and then investing in cash flowing, producing asset that's going to grow, that I think goes back to your point on the billionaires and that mind shift of why real estate is so powerful. But leads you into another scenario where you are deferring and we do a 1031 exchange. So do you see our model being practiced across the industry? Are we pretty unique in that we do this perpetual kicking of the can through 1031 exchanges, deferring gains, rolling over existing basis into a new property? Are we unique in that?
I definitely see that you guys doing it more strategically with a plan in mind. So I see that you approach it already from day one with the intent that, hey, this will need to be rolled just because of the depreciation, recapture nature of an eventual sale. So, but I do see it across the board as being part of the tax plan. This rolling forever, because another tax plan is passing away. It's part of that generational wealth. That's how partially can be created, because you could potentially indefinitely escape income taxes by if you pass away, you receive a step up in basis to full fair market value, and now you restart the depreciation 100%. So having this 1031 exchangeability in real estate, it's another unique feature that, again, is not available in any other asset class. It's only available in real estate that you can do that. And it's approved. And that applies both federal and state.
Yes.
So you're able to do that on both federal and state level. So it's huge too.
This morning, I'm like looking for YouTube videos on tax, free FAQ tax questions. I'm just trying to all right, what do we want to talk about?
Getting his mind going.
The first one I click on was a short, and the gal says, if I was to start from scratch and plan my life solely based on the tax code, I would pursue a career in real estate, be a real estate professional, and use the real estate professional designation to create a life where I pay no taxes. And it's like, Bonanza.
But it's so true.
Yeah.
I mean, that's exactly right. That's what I would do too. But in order for me to get there, I need a source of income that I can turn into investments. So that's why I like that the combination of having this S corporation, whatever that service business is, generate cash flow that I can then turn into passive income. So maybe at the beginning, it will be more towards, leaning towards more of the business income from the active business, but then I slowly turn that over and convert my income over into passive income when I'm a real estate professional. Mm-hmm. And take advantage of the tax write-offs. And I know that there are strategies that you can use. Just, hey, I'm just out of college and I'm going to start real estate investment, and now I'm going to start doing that. If you are able to do that, I would do that for sure.
Like start your career path in the real estate space.
In real estate space
Focus
right
on the
away.
niche.
And focus on that to be able to qualify as a real estate professional and take advantage of those deductions. Now, I would caveat this with that this 100% bonus depreciation that we have currently that they made permanent is in a unique situation, right? It wasn't like this 10 years ago. Still, the bonus depreciation was there, but it was 30%, 40%, 50%. So this is a unique situation. That's why this is the perfect time to do the investment, make the investments now, because they can't change it. They can't roll it back. So whatever deductions you're taking today, those are yours.
Yeah.
They never, even if they change the law next year or the elections come again in 2028, whatever deductions you take between now and they can't roll it back.
Yeah.
You keep it, and this is going to be the best way for you to shelter your future income too. Because again, this carry forward that we discussed, these NOLs, they don't expire. They stay with you forever. And I have clients playing this game. They're buying up real estate right now, knowing that they will need deductions for the next 10 years. So that just generate those deductions now.
Yeah, because you don't have to
carry
use
forward.
them. Yeah, you can
carry with them forward.
Yeah.
Do we have the same $620,000 limitation?
In every given year, yes. But that's why you're trying to create the carry forward losses. Because then you don't have that limitation. You have the 80% limitation.
And you just keep that snowball going of NOLs.
Exactly.
Net operating losses moving forward.
And honestly, there are multiple ways. We didn't go into all the details, but I had a client maybe in 2022, he bought a $300 million building just for depreciation. And that $300 million created $120 million in depreciation deduction, but he's going to use that for the next 10 years. Mm-hmm. So that was a way to be able to, preserve your wealth. You're not paying the government for 10 years. Can you imagine what that can do for you?
Yeah.
That goes tax free. And so it's powerful. Real estate investment is powerful.
And then when you don't pay Uncle Sam, you have more money to invest in more opportunities that buy you more depreciation, and it's just the snowball effect.
Buys you more cash flow too.
Buys you more cash flow, exactly.
You got to keep moving. You have to keep buying more.
Yeah, that's right. Yeah.
That's right.
So, Andy, thank you so much for all your time and all of your amazing advice. And we just really appreciate having you in our life and doing business with you. And thank you
guys. Yeah, appreciate it. It's been fun.
Thanks, Andy. Appreciate you, buddy. And thanks again for joining us for another episode of the Cashflow Quest. We hope we provided a bunch of value today, and hopefully you can save some money on your taxes. See you next time. See you.
Thanks, everyone.